Most people will never live off dividends. Not because they do not earn enough, not because they do not try hard enough, but because they are chasing the wrong number from the wrong investments, and they will spend 20 or 30 years working toward a goal that was completely unnecessary in the first place. The financial advice machine has convinced millions of ordinary investors that they need $2 million saved before their dividends can replace their income. That number is a lie. Or at least it is a wildly outdated and unnecessarily limiting way of thinking about the problem. Because in 2026, with the right combination of investment vehicles, $2,900 a month in passive dividend income is achievable with a fraction of that capital. And today I am going to show you exactly how, with real numbers, real funds, and a clear roadmap for each of 3 completely different strategies depending on where you are and how fast you want to get there. Before we get into the 3 strategies, let me make sure the foundation is completely solid, because dividends get thrown around constantly in financial content and genuinely understood by far fewer people than that coverage suggests. And if you do not understand the mechanism, you cannot evaluate the strategy. So let us build from the ground up. When you buy a stock, you are purchasing a fractional ownership stake in a real operating business. That business sells products or services, generates revenue, pays its employees and expenses, and whatever is left over is profit. The management team then faces a choice. Do they reinvest that profit to grow the business further, or do they distribute some of it back to the owners, the shareholders, in cash? When they choose to distribute cash to shareholders, that payment is called a dividend. If you own shares in a company that pays dividends, those payments arrive in your brokerage account on a regular schedule, usually quarterly, sometimes monthly. The amount you receive depends on how many shares you own and the per-share dividend the company has declared. The concept that makes all of this interesting as an income strategy is dividend yield. Yield is the relationship between how much a stock pays annually in dividends and what it costs to own it. If a stock trades at $100 per share and pays $4 per year in dividends, the dividend yield is 4%. That single number lets you compare income potential across completely different investments on a standardized basis. A stock with a 4% yield and a stock with a 10% yield both put cash in your account, but the second one puts 2.5 times more cash per dollar invested. Understanding the yield on your investments is how you calculate how much capital you need to reach any specific monthly income target. And that calculation is the entire point of this video. $2,900 per month equals $35,000 per year. The only thing that changes between the 3 strategies we are about to cover is how much capital you need to invest to generate that $35,000, because each strategy produces a different yield, and yield is what determines the capital requirement. Strategy 1. Covered call ETFs. This is the fastest path to your income goal in terms of capital required, and it is worth spending time understanding why, because the mechanics are different from anything else on this list. A covered call ETF generates income in 2 ways rather than just one. First, it owns stocks and collects whatever dividends those companies pay. Second, and this is the income engine, it sells call options against those same stock holdings to collect additional premium income from the options market. A call option is a contract that gives the buyer the right to purchase shares at a specific price, called the strike price, by a specific date. The fund sells that right to an option buyer and receives a premium payment up front, regardless of whether the buyer ever exercises the option. That premium income is what funds the high monthly distributions that covered call ETFs are known for. The trade-off is explicit and important to understand going in. By selling call options, the fund has agreed to cap its upside. If the underlying stocks surge above the strike price, the fund cannot capture those gains. They belong to the option buyer. In exchange for giving up that upside, the fund collects steady premium income month after month, whether markets go up, sideways, or down mildly. The 3 covered call ETFs worth highlighting in 2026 for an income-focused investor are XYLD, QYLD, and JEPI. XYLD is the Global X S&P 500 covered call ETF. It holds all the stocks in the S&P 500 and sells at-the-money call options on the index each month, writing calls on 100% of the portfolio. The current trailing 12-month yield is approximately 10.5 to 11%. XYLD has been paying monthly distributions for 12 consecutive years and has over a decade of real-world distribution history through multiple market cycles. QYLD applies the same strategy to the Nasdaq 100, which has historically higher volatility and therefore generates larger option premiums. Its current trailing 12-month yield is approximately 11.8 to 12%. GP, the JP Morgan Equity Premium Income ETF, uses a slightly different mechanism, equity-linked notes rather than direct index options, and actively manages a diversified equity portfolio, currently yielding approximately 7.5 to 8% with meaningfully better long-term total return than XYLD or QYLD because it caps less upside. Your choice between these three comes down to whether you prioritize maximum current income, better long-term sustainability, or a balance of both. Now, the number that matters most. How much capital does John need to invest in covered call ETFs to generate $2,900 per month? Using a blended yield of approximately 11% across a diversified covered call ETF portfolio, the calculation is straightforward. $35,000 divided by 0.11 equals approximately $318,000. Compare that to the traditional advice of investing in individual dividend stocks with an average yield of 1.5 to 2%. At those yields, you would need $1.7 to $2 million to generate the same income. Covered call ETFs compress the capital requirement by roughly 6 times. That is the entire appeal of this strategy for investors who do not have decades to accumulate a multi-million-dollar portfolio. $300,000 to $320,000 is still a serious amount of money. But it is a goal that changes from fantasy to realistic long-term plan for a disciplined investor. The honest risks to acknowledge: covered call ETFs tend to underperform simple index funds in strong bull markets because they cap their upside. In 2023 and 2024, when the S&P 500 surged on AI-driven tech leadership, XYLD's NAV lagged meaningfully behind a plain VOO position. If you are not drawing income and can reinvest all distributions, a pure index fund likely outperforms over long periods. Covered call ETFs are optimized for current income extraction, not maximum total wealth accumulation. They work best for investors who genuinely need the cash flow today, rather than investors who could afford to let the money compound and simply prefer the high-yield number. Strategy 2. High-yield REITs. A real estate investment trust is a specific legal structure that allows investors to own income-generating real estate without buying property directly. The structure requires REITs to distribute at least 90% of their taxable income to shareholders each year in exchange for favorable tax treatment at the corporate level. That mandatory distribution requirement is why REITs tend to offer significantly higher yields than ordinary stocks. When you invest in a REIT, you are buying a fractional ownership stake in a portfolio of properties: shopping centers, apartment complexes, office buildings, data centers, healthcare facilities, warehouses, and receiving a proportional share of the rental income and other revenue those properties generate. For income investors, REITs are compelling because they connect your investment income directly to the real economy of rents and property utilization, rather than to the options market or corporate dividend decisions alone. REITs carry a specific risk profile worth understanding clearly. Unlike covered call ETFs, whose income depends primarily on options market volatility and stock prices, REIT income is directly tied to real estate market conditions. Occupancy rates, rental demand, lease renewal rates, property valuations, and interest rate levels all affect a REIT's ability to maintain and grow its distributions. Rising interest rates create a double headwind for REITs. They increase borrowing costs on the debt that most REITs use to finance their property portfolios, and they make the REIT's distribution yield look less attractive relative to risk-free alternatives. This is precisely why REITs underperformed significantly in 2022 and 2023 as rates rose. Conversely, when rates fall or stabilize, REITs tend to recover strongly. which is part of why they are attracting renewed interest heading into 2026 as the Federal Reserve's rate cycle appears to be moderating. For an investor targeting $2,900 per month through our REITs, the relevant calculation depends heavily on which types of REITs you select. Mortgage REITs, which own mortgage-backed securities rather than physical properties, tend to offer the highest yields, some in the 15 to 20% range, but come with higher sensitivity to interest rate movements and credit conditions. Equity REITs that own physical properties in high-demand sectors, industrial warehouses and logistics facilities benefiting from e-commerce, data centers driven by AI infrastructure spending, healthcare facilities serving an aging population, tend to offer more moderate yields of 5 to 8%, but with more durable long-term fundamentals. A portfolio blending both types across different real estate sectors could target an average yield of approximately 10 to 11%. At that blended yield, generating $35,000 per year requires approximately $300,000 to $320,000, similar to the covered call ETF path. For investors who want maximum current yield and are willing to accept significant interest rate sensitivity, mortgage REITs offer yields that can push that capital requirement down further. For investors who want more property-backed stability and long-term income growth, equity REITs in structurally growing sectors are the more appropriate building block. Spreading across 10 to 15 different REIT holdings across multiple property types is the standard approach to managing concentration risk within this strategy. Strategy 3. Dividend Aristocrats. This is the most conservative and most time-tested approach of the three, the path chosen by investors who value reliability above all else and are willing to accept a longer runway to their income goal in exchange for the stability that comes from owning companies with extraordinary dividend track records. Dividend aristocrats are a specific, formally defined group of companies within the S&P 500 that have increased their dividend payment every single year for at least 25 consecutive years. Not just maintained it, actively raised it through recessions, financial crises, bear markets, and inflationary periods. To sustain 25-plus years of consecutive dividend increases, a company needs a genuinely durable competitive position, consistent earnings generation across full economic cycles, disciplined financial management, and a board of directors committed to shareholder returns as a core business priority. The companies that make the cut read like a list of the most reliably profitable businesses in American corporate history: Johnson & Johnson, Coca-Cola, Procter & Gamble, Lowe's, Colgate-Palmolive, Aflac, Automatic Data Processing, and dozens of others across consumer staples, healthcare, financials, and industrials. The average dividend yield across the Dividend Aristocrats Index today is approximately 2.5 to 3%. Meaningfully lower than covered call ETFs or high-yield REITs. At first glance, that looks like a weakness. It is not. The yield is lower because these companies have grown their share prices substantially over time. The dividend payout has risen consistently, but so has the stock price, which moderates the yield percentage even as the actual dollar income delivered per share increases each year. An investor who buys Dividend Aristocrats and holds for 20 to 30 years typically finds that the yield on their original cost basis, what they actually paid, grows dramatically higher than the current advertised yield as both dividends and share prices compound over time. The Dividend Aristocrat strategy is a compounding machine. It grows both your portfolio value and your income simultaneously, with lower volatility than the broad market and lower capital risk than high-yield mortgage REITs or full covered call strategies. The capital requirement for the Dividend Aristocrats path to $2,900 per month reflects the lower yield. At a 3% average yield on a well-diversified Dividend Aristocrats portfolio, generating $35,000 per year requires approximately $1.1 to $1.2 million. That is a larger capital base than either of the first two strategies. However, there are two important points of context. First, an investor who builds this position gradually through consistent monthly contributions and dividend reinvestment over 10 to 20 years is not starting from zero. Compounding does meaningful work throughout that accumulation period. Second, the Dividend Aristocrats portfolio will continue growing both in value and in income even after you start drawing from it, whereas covered call ETF and high-yield REIT portfolios carry more risk of NAV erosion over time depending on market conditions. The slower path gets you to a more durable destination. For investors in their 20s and 30s with long time horizons and the discipline to reinvest everything during the accumulation phase, the Dividend Aristocrats route can ultimately deliver the largest total outcome even if the monthly income number looks lower at any given snapshot along the way. Let me put all three strategies side by side now so you can see the complete picture clearly and understand which one fits your situation. Strategy 1. Covered call ETFs requires the least capital up front, approximately $300,000 to $320,000 at an 11% blended yield to generate $2,900 per month. The income arrives monthly, which is practical for budgeting. The trade-off is capped upside, meaning the portfolio is unlikely to grow dramatically in value over time, and NAV can erode in strong bull markets. This strategy suits investors who need income now and have the specific capital available. Strategy 2, high-yield REITs, also requires approximately $300,000 to $320,000, depending on the blend of equity and mortgage rights selected. REITs offer direct connection to real estate income, most pay monthly, and the better equity rights in structurally growing property sectors offer meaningful long-term income growth potential. The trade-off is meaningful interest rate sensitivity. This strategy performs significantly better in falling or stable rate environments than in rising rate environments. Strategy 3, Dividend Aristocrats, requires approximately $1.1 to $1.2 million at current yield levels, making it the longest runway to the income goal. The trade-off, a larger capital requirement, buys genuine stability, long-term income growth that compounds powerfully over decades, and a portfolio that is likely to pass through severe market downturns with far less damage than the higher-yield alternatives. There is no universally correct answer here. The right strategy depends on three things specific to you: how much capital you currently have or can realistically accumulate, how urgently you need the income versus how long you can remain in accumulation mode, and how much volatility and income variability you can tolerate without making poor emotional decisions. Many of the investors who will ultimately build the most successful dividend income portfolios will not choose just one of these strategies. They will use covered call ETFs to generate meaningful current income, while REITs and Dividend Aristocrats compound and grow in the background, eventually shifting the balance toward the more conservative income sources as total portfolio size grows and the income goal comes within reach. Building toward passive income is not a binary decision. It is a phased strategy that adapts as your resources and needs evolve. What matters most is starting with a clear understanding of exactly what each strategy costs, what it delivers, and what you give up. If this roadmap gave you a clearer picture of what it actually takes to reach $2,900 per month in dividends and why the $2 million number that gets thrown around is not the only path, hit the like button and subscribe. I cover dividend income strategies, ETF comparisons, and real portfolio building every week. Drop a comment below and tell me which of the three strategies you are currently pursuing or most interested in exploring. I read every single one. I will see you in the next one.